Hi, and welcome to another Big Trends Indicator Library course. Today we're going to cover acceleration bands. And once again, my name is Andrew Hart. So we'll be here with you over the next hour to hour and 15 minutes, really learning the ins and outs and everything about acceleration bands. Not only where it came from, how it was created, but obviously how we traded on the both bull and bear sides. And we'll take a look at a number of examples, both based on markets, entire markets, and obviously individual stocks. So without further ado, let's go ahead and just get started. Alright, well, as you guys know, access to Big Trends and its coaching services is provided for educational and informational purposes only. The information presented here does not constitute a recommendation to buy or sell a particular investment. You're solely responsible for your investment decisions, and Big Trends and its staff are not responsible for any trades that you choose to make. Not all Big Trends products or services are appropriate for all investors. Big Trends does not provide personalized financial, tax, or legal advice. So please consult your tax consultant prior to making any investments that may impact your tax situation. Okay, so a little bit of a background here. Let's just talk about acceleration bands. Now, clearly the term acceleration means strong, right? When we talk about trading options and trading trends in stocks and indexes and ETFs and Forex, so on and so forth, we're really trying to find the strongest trends. Well, acceleration bands are doing exactly that. What are they seeking to find? They're actually seeking to find, and we'll look at this, they encompass 95% of price action. But more importantly, we're trying to find the fastest up and down moves that really accelerate. Obviously, that happens in a minority amount of time, which is really that 5% of price action in general over a given time period. So basically, as everyone does in technical analysis, including us, and most likely you started out trading with moving averages, right? You started trading with, let's say, simple moving averages, maybe moved along to exponential moving averages, right? And of course, what do those do? They really give you a smoothed out effect of whatever the underlying price action is. But of course, what happens to the strongest stocks and the strongest ETFs and the strongest indexes? Well, in fact, they never come down to test those major moving averages. Of course, that's one of the original tried and true methods in trading stocks and using moving averages with them is, you wait to a cross and, let's say, a confirmation from a Big Trends perspective on two moving averages. Of course, what happens? You look for a shorter term moving average to cross above a longer term moving average. Well, then what do you wait for to buy options? Well, you can buy them immediately right then if you're long a particular stock. And then when do you add to your position? When it comes back down to test those moving averages. Well, guess what? The best and the strongest trends, they never come back down to test those moving averages. And of course, you look for those best ones, and that's what you want to get in on. So of course, what have we created in order to really define those trends? Not necessarily even looking for the pullback, but looking for those incredibly strong and incredibly rare momentum plays. And that's why we created acceleration bands. So as it says there, obviously, these acceleration bands encompass, which means what? The price action inside the upper and lower bands encompass 95% of all price action. So, of course, we're using by the concept of adaptive bands. What does that mean? Acceleration bands under the hood, so to speak, are exponential moving averages. A lot of you, so many of us use Bollinger Bands. Well, when I use Bollinger Bands, and predominantly across the industry, most professionals and most traders alike will use simple moving average Bollinger Bands, and that's what I recommend as well. But with acceleration bands, we'll take a look at the formula here in just a second. They're different than Bollinger Bands because they don't really adapt. They adapt, but not as fast. Bollinger Bands are much more sensitive to the price action, leading many traders to whipsaws, false signals, so on and so forth. Acceleration bands are much more they're much more adaptive, and in that we mean that it doesn't just expand and contract so much on the short term, leading traders to obviously less profits or just blowout positions. We're looking for something that really, once it defines, boom, you get on and you get out when it's out. So there's a really basic trend here. It either confirms or it doesn't. So basically, what exactly is a confirmation on acceleration bands? How does it work? Okay, well, first off, we use these because acceleration bands, obviously, we're not going to trade the price action in the middle, right, in between the upper and lower band. Why? That's 95% of the price action. That's where everyone else is trading it, looking to catch the move before it happens. And typically, if you try to catch a move before it happens, what? It never happens, right? So we only will trade price action outside of the acceleration bands. Now, what we've been taught traditionally is what? We always look at acceleration bands and we say, well, what's the difference between these and Bollinger Bands? And of course, we know the traditional way to trade Bollinger Bands, right? Traditionally, we look for when it comes to the top of that Bollinger Band, it's likely to reverse back down. That everything's stuck in a trend, right? And it just goes from top to bottom, either slowly moving higher or slowly moving lower. But in reality, we know that some stocks will take off in the short term incredibly fast. Conversely, they'll fall off the side of a cliff just as fast the other direction. Now, what do those look like on a Bollinger Band? And we'll take a look here in a few minutes. But essentially, in most times, you'll see Bollinger Bands will really adapt and move very, very fast. Even if you see a 30 or 40% drop in a stock in a one day, a gap down by that much, you can see within a couple of days you'll have a massive bubble on the upper and lower Bollinger Band, and it will, in a very, very fast fashion, adapt to that and really seek to get that price action all back on the inside of the Bollinger Band, right? Because it's looking at standard deviations. So obviously, the acceleration bands are looking to not really expand and contract as much, but obviously on a statistical basis, look for any of the moves on the outside. Now, what are those moves on the outside? They're rare events, right? These are the extreme moves. By the way, this can occur on pretty much any time frame. We're talking, 1 minute, 5 minute, 15 minutes, 60 minute, daily, weekly, monthly. And we'll take a look at each one of those examples. It truly is incredible how effective acceleration bands have been, how effective they are, and how effective I believe they will continue to be into the future. One of the people talk about the 5%, right? That very, very small, rare moves that happen in the market, in individual stocks and Forex in this case. Everyone knows the famed money manager George Soros stated that, where did he make most of his money? Well, what he called fat tails, which is obviously a statistical term, is where he made most of his money, right? This was the 5% of price action. The 5% that isn't accounted for in your traditional patterns or your traditional statistical analysis, right? These things are the very rare moves that are the fastest movers, up and down. And obviously this is exactly what acceleration bands is trying to capture and really quantify for us. So basically, what are we trading? We're trading the bubbles, right? We're trading all these very, back in fall of 2008, we had obviously a massive downward bubble, I guess you can call it, but obviously it was a very, very fast moving market that was of course caught by what? Acceleration bands. That was a very great signal. By the way, just in the last, I believe it goes back to about 2005, as you may imagine, the U.S. domestic market, the SPY ETF, which is the S&P 500 ETF, what you'll notice is that because